Welcome to the Investor Fuel Real Estate Investing Show, where I interview the nation's top real estate entrepreneurs, industry leaders, and other amazing entrepreneurs to help educate and inspire you to take your business and your life to the next level. My goal is to add tremendous value to you during every single episode of this show. If you get value, I'd love it if you subscribe on your favorite podcast player, subscribe on YouTube, and my very favorite, please share this with your community so we can impact even more entrepreneurs. Let's start today's show. Hey everybody, welcome back to the show. Today we're going to be talking about how to drive more money into your bottom line, but we're really talking about some tax strategies. We're talking about the Trump bonus depreciation that is very likely coming back here, and we're talking about it with somebody that knows it more than most, Mr. Joe Viery. So Joe, welcome to the show.
Well, thank you, Mike. Good to see you.
Yeah, good to see you. So we were just talking about, well, a whole bunch of stuff. We're talking about, there's a lot of real estate investors that leave money on the table because there's all sorts of tax advantages to doing certain things that they just don't know about. And quite frankly, their accountants don't even usually mention because this is not an account. I mean, I don't say it's not accountants aren't trained to do this stuff. Like this is some stuff that's kind of above and beyond. And so excited to have you today. So, hey, before we jump in, Joe, tell us a little bit about because by the way, you run a firm that helps investors do this and have saved them probably millions or tens of millions of dollars, but you're actually not an accountant yourself. You're more of an engineer. Is that right?
Correct. My company, U.S. Tax Advisors Group Incorporated, we're an engineering-based company, and we provide two types of studies. One is accelerated depreciation, which is called cost segregation. And then we also get involved in the energy tax credits and energy studies, which result from any value add clients fixing up, improving their properties, and improving the energy efficiency of the property. There are tax credits and write-offs available.
Yeah. Yeah, we're going to get into that for those of you that are listening today too. So a lot of this stuff, people assume it's like, oh, I have a rental stuff and I do some cost segregation or I've taken the bonus depreciation on that. But what we found out, and I know Joe believes this too because we've talked about this in the past, is just getting the message through that there's actually some significant tax advantages for home flippers. You buy and sell it, it doesn't matter. But if you put in a new AC unit, you put in new windows, you do, I'll let you kind of talk more about it when we get to it. But talk about some things that you're doing to make the property more efficient. There's some you guys are probably leaving on average $2,000 to $5,000. I think that's probably safe to say on the table. And this is not tax credit. These are actual $2,000 to $5,000, not in tax reduction, but in real dollars. I think
in real credits. Correct.
Yeah. So Joe, as we jump in here, I know we're going to talk about what's going on with the renewing all the Trump tax laws that is probably coming up here this summer. I haven't seen many people that have saying this is not going to happen, but it's the government, so who knows? But the big thing there was the bonus depreciation, allowing you to basically escalate all of your the cost seg taxes. You can kind of move that all into the first year and get effectively bonus depreciation, right? So tell us a little bit about that and what you know at this point. We're recording this here in May, kind of mid-May. And so where you think this is going and what this might look like this year.
Okay, perfect. And let me set the table. I've been in the industry since 2007, and we did not have bonus. Bonus came about in 2018, and it's effective for properties that were purchased in September of 2017. And what happened is, it's a little bit complex, but I'll dumb it down and make it easy, is that when you don't have bonus, what you're doing is you're dealing with short-lived assets like 5-year. 5-year life is the interior of the building, like countertops, flooring, window coverings, specialty lighting, etc. And then you have 15-year property, which is your land improvements. And you'll always have the main core of the building, which is in real property, which is for residential, 27.5 year, and for commercial, 39 year. So what happens is when you combine all of those lives, what will happen when you don't have bonus is that we will calculate the amount of each bucket, 5-year, 15-year, and the long-term assets. But when you do the math, because of how the math works, is if you don't have bonus, you'll get about 75 to 80% in year one. The other 20 to 25% goes over the next 5 years. So you'll still get the entire amount, but you're going to have to wait 5 years to get that final amount. But you'll get most of it year one. The advantage of bonus is that what we find in the short life assets, all of that, 100% of it, you can deduct in year one. So is it an advantage? Well, yeah, because of the time value of money, you always want to get your deductions as soon as possible. You don't want to wait over time if you can avoid it. So what bonus will bring back is they'll bring back, bada boom, you'll get the 100% deduction. Right now, what happened is it went from 100% from 2017 to 2022. And then every year after, 23, it dropped to 80, 24, it drops to 60, 25, now it's 40, next year it's 20, and then it's gone. And so what the new law is going to do is it's going to bring back the 100% bonus, and they're going to make it not a short-lived passing of a rule, meaning they're going to make it permanent. They're going to say 100% bonus is permanent.
Yep.
We expect that to be in the new tax law, but I don't have a crystal ball. They said it was going to be done in April. Then they said May. And I just heard Mike Johnson now say that they're hoping to pass the tax bill in July.
Yeah, 4th of July is what I've heard. They're hoping to get it passed, but we'll see. So one thing to kind of clarify here, Joe, is, for example, before the Trump tax laws came into place, there was always cost segregation, like you said.
Yes.
So you could basically, normally real estate, like the accounting laws are residential real estate, you depreciate over 27 and a half years. And that's on the structure of the whole property, right?
Yep.
But when you put things in like carpet or mini blinds or the things that are clearly not going to last 27 and a half years, there's essentially a schedule that says, hey, you can itemize the depreciation where it's like these things you're going to depreciate over 5 years. These are over longer. What the bonus depreciation does is it allows you to collapse all that into year one, essentially, right? So you should be doing cost segregation with or without these Trump tax laws and this bonus depreciation. You should have been doing this all along because it allows you to accelerate things faster that are never going to last 27 and a half years. Am I saying that right?
You are saying that right.
Yeah.
But the wrinkle is that until about 5-6 years ago, the smaller buildings were being ignored by cost seg companies. And so what happened is if you had somebody with a single family home, it wouldn't pencil out the value proposition, because I would be charging $3,000, $2,500, and it wouldn't be worth paying that amount of money to do the study.
Right.
Whereas we've developed another technique where we can do it analytically, and we can do a very tight, really well done program, and we charge under $1,000. And so that now opens the world up to a huge bunch of investors. But most accountants don't even know we exist, that you can do
exist,
it.
Yeah. I forgot about it because I've known you for so long, and you've done it on all of my properties, and I kind of forget that a lot of the world still doesn't really know this is a thing. Like, they've known this is a thing for big multifamily, commercial, big properties, but you can do this on individual single-family homes now, and you should, by the way. You save probably 10, 20x what you pay to have the study done.
Exactly.
It's kind of
I like to say the minimum, and it's just something that somebody told me when I first started, 10 times my fee.
Yeah.
So if I charge you a fee of, let's say, $700, I would say do it if you save at least $7,000.
Yeah.
Right. In other words, but most of the time it's not 10. Most of the time what we provide is 20, 30, 40 times the fee.
And Joe, one thing I don't know if I'm going to say this right, but one thing, because I own a bunch of multifamily as well, we always, during the last several years, we've gotten all that bonus depreciation. I know it's been kind of winding down. But then there's a lot of people that are like, well, you have to pay it back when you sell the property, and you're going to have to reclaim. But the truth is any of that stuff, let's say a bunch of it is 5-year cost segregation stuff. If you hold it for more than 5 years, you don't have to pay that back, right?
Right. That's the advantage. Cost segregation lowers your depreciation recapture.
Right.
Because if you have the good example, 5-year property, 5 years down the road, you sell the building for cash. Basically, you're not going to pay recapture on the 5-year property because we've identified it.
Right.
If you didn't do cost seg, you wouldn't know what the 5-year property is. You can't make this claim to the IRS. So a third of the 15-year property is also not included in the computations for depreciation recapture. So you'll always will get depreciation recapture. Just to be blunt and straight, you will get it, but it will be less if you segregate the building.
Yep. So, Joe, one of the things that we talked about up front is that you're not an accountant, you're an engineer. You figured out a process to do this that the IRS is fine with. And your average accountant, this is what I've kind of realized, being in a place where I'm an advisor to hundreds of the top real estate investors. People are always like, hey, I need a new accountant. And I'm like, you need a paper filler outer or do you need a strategist? Like there's a very, very, very big difference when you have a business of any significance, really when you have a business of any size, is to like, the truth is most accountants, most like, Main Street accountants are good at filling out forms, but they're not strategists where they're working with entrepreneurs to basically help them figure out ways to minimize their tax bill. And so I realized a long time ago, like I don't need somebody to fill out the forms. I mean, I need somebody to do that. But, and then what you find out is you can find the strategy firms, like the folks that I've worked with for a long, long time. They're like, yeah, we'll do all the paperwork because it kind of comes with the territory, but that's not like, don't work with us for that. Like we're going to help you minimize your tax bill. And they're looking for things like this, right? They kind of know where the bones are buried. They're looking for strategies to help real estate investors or all entrepreneurs save money. So with that said, let's talk a little bit about why most accountants don't even know this exists. They're not going to necessarily probably even bring it up to you. And they actually can't even do these studies, right? They can't do that themselves. They work with folks like you to do this, right?
No, that's correct. Basically, in speaking around the nation, I always get asked one question is, give us your something you can recommend, a tip or whatever. And I say, look, you got to surround yourself by people who are very, they're real estate specific. And the number one is going to be the accountant. You have many different accountants out there, but to find one who knows all of the strategies that are legal and available to you. The reason why they don't is because if your accountant, for example, works with a lot of people who work at Costco and only have a handful of people in real estate, there's 7,000 pages, something like that, of tax law. They don't know about depreciation. They do not know how to do cost segregation because they can't. So my advice is surround yourself by a team of people who are very well educated, and especially in real estate. And right. I don't care if you pay more, you are going to save money by finding that person. Even though their fee might be higher, you are going to get so much benefit from an accountant who knows real estate that it'll pale, whatever extra you pay.
Yeah. I learned that early on. I had a fairly... we started, this is early on in my career, 15, 17 years ago. We started working with somebody that really knew tax strategy. And it was like expensive, but I realized for every hour I pay that person, like by the hour, they were saving me like 20x what we were paying them or more. And it's just like they just talk differently. They're like, here's a way to do that. They're not like, here's how to do it. Like, here are some ideas strategically on how to minimize your tax bill, which I think all of us as entrepreneurs clearly feel like we've paid more than our fair share. So anything we can find, you're basically paying for that knowledge of people that have figured out how to work with entrepreneurs and how to help us minimize our tax bill. And
that's why being around people like you is so valuable, because you put together in the room all kinds of people who know real estate and can provide you with great knowledge, rather than you taking the time to learn it yourself. Forget about it. You're just wasting your time. Just, call Mike and ask him if you need whatever you need, whether it's accounting, whether it's entity structure, whether it's how to buy and sell properties. If you pay and find somebody who's good at it, you will save money. And that's how the people in your mastermind created wealth, Mike, is that they did that by being a part of the group.
Yep. No, I appreciate that, Joe. So let's talk a little bit about, just to kind of put a bow on that last conversation about working with your accountant, is you guys prepare a report that you just hand to their accountant and say, this is how to account for that, right? I mean, you kind of work hand in hand with folks' accountants, right?
Yes. What we do is we will provide the report. We will help them if they do not know how to implement the report. But again, if you find the right accountant, they should know how to implement what we give them, all the numbers that we give them.
Right.
And again, like you said, we're not the accountants. And what we do, this is important in cost seg. We use meaning the building owners or their accountant's numbers. We don't make up the numbers. A lot of people think we make up the numbers, but I need to know what your accountant is going to assign to the building basis. I don't assign the building basis, because what the building basis is, it's whatever you bought the property for less the land part, because land is not depreciable. So somebody's going to have to figure out what the land's worth, and then that is the building basis. And so we work off of the number given to us by the accountant, and then we do our work and we give them the results, and they apply it in the tax return.
Yeah, that's great. Let's talk about some of the ways to save money that investors often miss. And I'll say that I think everything we just talked about so far on the show is, at least in my circles, there's a lot that still don't quite understand everything we just talked about here. And you guys should reach out to Joe and talk to him about that after the fact, how he can help you. But is rehabbers. So they often think, well, I'm not keeping the property, so they can't use the bonus depreciation stuff. They can't, they don't need to create a cost segregation study on a house that they're fix and flipping. However, if you're selling to investors, you should advise them on how to do that, because you can save them money. I mean, people want to work with you more. If it's going to be a buy and hold, if you're selling it to somebody that's probably going to keep it as a rental, you should be notifying them. I mean, just if you want to work with them again, just provide goodwill to say, hey, here's a way that you can save a ton of money in your first year. Let me connect you with somebody like Joe's company here that could do that for you. However, there's a whole bunch of tax benefits that rehabbers, and I'm talking guys that are doing hundreds of deals a year, just don't even know exist. And so talk to us about some of the other things that are out there right now, and I guess what that's looking like these days in terms of, are these things that are winding down, picking back up? Do you see the current administration putting more of these types of things in place because they're generally kind of pro-business and certainly even pro-real estate? So I guess tell us a little bit about what some of those examples are, and then let's talk about what that looks like in the coming years maybe.
Well, one of the areas that I see a lot of building owners not taking advantage of are dispositions. Okay, that's pretty important, and a lot of people ignore that. So if you're a value add, if that is your model, value add, basically what you're doing is, we know what you're doing. You're buying a property that needs work, and you're ripping stuff out and you're throwing it away. And every time you throw something away, that has residual basis or value, which means you need to write that off. So let's use the example of a roof. You have to replace the roof, and basically you're going to take the old roof off and throw it away and put a new roof on. We already know what the new roof is worth, because you're paying a contractor for the cost of the roof, but you don't know what the old roof cost, because that's what we do when we break down the building cost segregation. So we will give you the keys to that kingdom, and the IRS wants you to dispose of that roof, and you want dispositions, because dispositions are write-off. They're the number one level of taxation. In other words, write-offs are gold, and you want to throw that old roof away. And I find a lot of building owners and their accountants, just because they don't do cost seg, don't know what the value of all these components are, and they don't take advantage of that. And that's just like money hanging on a tree. You want to grab as much of that fruit as you can.
Yeah. So the example is, you said, if I said, let's just say carpet is typically like a 5-year depreciation on cost seg. So let's use carpet as an example. If you are like me and you by the way, I do not use carpet in rentals anymore. Like several years ago, we're never using carpet again. But for a long time we did, because it was really the cheapest flooring, but it's inevitable that it has to be replaced almost every time we have turnover with the tenant. But if we got the cost seg study and you said, hey, this isn't going to last 27 and a half years, it's only going to last 5 years, and you have a tenant in there for 1 year or 2 years, and they tore it up and you have to replace it, you don't have to continue to expense that over 5 years. That was effectively the same as bonus depreciation. Just write it off now because it's gone. Put the new carpet in, or don't do that if you're listening to this, and then you're going to restart the clock at another 5 years, depending on the bonus depreciation situation. So all that stuff that people are tearing out that is somewhere in this cost seg study that's still being depreciated every year, you can accelerate that because it's gone now, right?
Exactly. And that's what we do as engineers. We break apart how that building basis. So in other words, we don't care what a 2x4 costs at Home Depot. That's irrelevant. We allocate what the 2x4s cost compared to the basis of the building. So if your building basis is 500,000, all of our math has to equal 500,000. And we break down all of the components of the building, and all the components would be just like you said, roofing, HVAC system, electrical. We break down all the components of the building. So when you do need to throw something away, you know what the residual value is.
Right. Yeah, that's great. That's
Yep.
great. And your accountant will know too if you have this study, right? Because it has basically a schedule of what's being depreciated over what period of time, right?
Exactly. Yep.
Yeah, yeah. So let's talk about some other things that rehabbers are missing out on. I know that there's some incentives out there for making houses more energy efficient and things like that. And it's the amazing thing about this is it's stuff that a lot of people listening to this right now are already doing. They just don't know what the process is for how to get, $5,000 back for every house that they flip. So can you talk about that a little bit?
Yes, and what happens, you mentioned depreciation recapture. And because of recapture, we tell our clients, prospective clients, that they should plan on holding the building at least a year and a half to 2 years. So therefore, flippers were not, I don't advise a flipper to get involved in cost segregation, accelerating the depreciation expense, because the math doesn't work out. But let's say now one thing that a flipper can do is if they are a value add flipper, which most all are, you're going in there and you're remodeling, you're renovating the building. Most likely you're increasing the energy efficiency of the building. And as long as my engineer can attest that you're over 50% better than the baseline, which of course we know what the baseline is for the properties, and it does change by location and a lot of factors. But if you get 50% over that target, you can get a tax credit called 45L. And guess what? You can do this going back 3 years, even if you sold the building. So even if you sold the building, however, we are going to need to know what you did. You can't make it up. We don't do makeup stuff. So basically, you're going to have records that show what you did in the building that you sold 2.5 years ago. We need to know what HVAC you put in, the lighting, the insulation, the doors, the windows. We do have to document it and make sure it's accurate. But as long as you can tell us that, what you did, we can go back and you can get a tax credit that range between $2,000 and $5,000 per door. And, for a multifamily, you have 100 doors. That's a lot of money. But even a single family home, you can get a tax credit of $2,000 to $5,000.
Yeah, that's amazing. So, because a lot of us are, replacing the HVAC system, sometimes putting in new windows, sometimes blowing in new insulation, almost always putting in new light fixtures. And a lot of that stuff, you don't have to necessarily go. Like let's just say, if you're a rehabber, like for example, I generally don't pick out my light fixtures because we just use the same ones over and over and over again.
Right.
But they tend to be, we're removing something that's been up there for 15, 20 years and we're putting in something that probably has an LED component that naturally is more efficient anyway. So for the rehabbers that are out there, they don't have to go pick out some much more expensive fixtures and all this stuff necessarily. No. They don't have to, go pick out something from a special store. This is stuff they're probably are doing anyway. You just have to document it. Is that right?
Yeah, you know what? When you go to nowadays, most of your Home Depot, I'll pick on them. Home Depot, I would be shocked if they're selling anything that's not energy efficient.
Right.
They just don't. You don't buy a light for a residence nowadays without it being LED or some energy efficient type of a light. The same thing goes all the way down the road. HVAC, maybe you could go super, super cheap and get one with the SEER value, which is the value of the output of the unit. I mean, maybe, but most of you out there don't go that cheap. You just buy what is a standard HVAC system. All of them are energy compliant. All that needs to be done is our engineer needs to document that, yes, you've met this threshold and you can get the tax credit. And that's what we charge you for. And that's the report we give to you and to your accountant.
Yep. And these are the types of things that you just accumulate a report for each property and give to your accountant at the end of the year?
Correct.
Is that how it works, Joe?
Yep.
Yeah. That's great. So what are, like, in terms of these, let's just say the current administration is probably generally more business friendly from a tax standpoint. They understand the pain, especially on the real estate side. They generally think that a lot of the environmental type stuff has gone way overboard and is a huge burden on real estate investors. So for some of these like energy type efficiency things or any other benefits, like where do you see that going over the next couple of years? And is there anything that's been kind of at least brought up that it might be in the tax bill to kind of benefit entrepreneurs and or real estate investors like us?
Well, as far as energy goes, I know what you're referring to. There has been some discussion that they may be, some of the energy, other strategies out there. But as far as what I'm talking about, the 45L and 179D, I think that it is past the point of no return. They may be able to take some of the other energy, tax credits you get, but not the ones I'm referring to, because I don't think the public would go for it. In other words, they're not going to pull these tax credits off the table. Could they? Of course they could. They could also do that for cost seg, but it's past the point of no return because we've been accelerating depreciation for 50 years. For them to try and take it away, I mean, they could try, but I don't see the motivation.
Yeah. And I'm saying more of like, what other things do you see coming up? Because there were rumors before they're not going to allow anybody to have gas ovens. It's like it's all going to go to electric. It's like, well, that's all just coal powered anyway. But a lot of that stuff doesn't make sense. But I don't know if there's anything else that might be coming that you think would benefit us that we should keep our ear to the ground on. No,
not on my radar. My radar is everything is just, and once they get that new tax bill approved, and if it does, of course, include, they don't have to include 100% bonus, but we all know that that's what they want to do. But I don't anticipate anything new coming out. I think it's just the 100% bonus is going to make everybody feel really good. Again, I don't look at it that way because you're still going to get the same amount after 5 years. And most of my clients don't buy properties and sell them in 3 years. They do hold them.
Yeah. And you might not know this yet, but do you think we're in this year now where the bonus appreciation is down to 40%. Will that be retroactive where you can probably push forward anything you have that's kind of in that cycle right now, or do you not know that yet?
There's been a lot of scuttlebutt going back and forth on how they're going to play this out.
Yeah.
Are they going to allow us to go back to 2023 and bump that 80% up to 100? We don't know. And there's been a lot of rumors that it's going to be effective immediately going forward. There's a lot of rumors, hey, it's going to go back, and somehow they're going to get it so that you can claim the 100% bonus going back, but we don't know yet.
Yep. Well, Joe, if folks, one of the ways for you guys to have your ear to the ground here, what's going on, is not for you to be watching the news every day to see what's going on. It's just to be in proximity to guys like Joe that are looking out for you, that can kind of tell you what to do, and having a good, as you said earlier on, having a good team around you. Of course, being in a mastermind like Investor Fuel, where we're talking about this stuff all the time, right? But Joe, if folks want to connect with you to learn more about how, if they hit any of these things, by the way, I've always loved when people come into Investor Fuel and they haven't done the bonus depreciation. Of course, a few years ago it was even better when you've got guys coming in with 100 or 200 rentals. They've never done the bonus depreciation. I was like, oh my God, let me show you how you can save hundreds of thousands of dollars this year. I'm going to connect you with a guy named Joe, and he's going to knock your socks off. But for those of you that I haven't had a conversation with yet, how do folks get a hold of you and how do they learn more?
Well, it's simple. It's U.S. Tax Advisors Group Incorporated, but really simple, USTAGI.com.
Awesome.
And one thing they're going to be taken to they can ask for our no-cost estimate. We do the first round to see if it makes sense for you. We do that at no charge. So you go online, you can give us the information we need on the property for either the energy studies or cost seg, and we will get back to you. We'll tell you how much, and we'll tell you how much benefit you're going to get, and then you decide whether that's right for you. And if you say yes, then we're off to the races.
Yeah, that's great. That's great. Awesome. Well, Joe, great to see you today.
Good seeing you, Mike.
Yeah, always good. Guys, you gotta squeeze as much of the juice as you can out of this fruit that you're harvesting right now. You kind of, even in the market we've been in, it's been a bumpy road. You need to make sure that you're making and maximizing your profits for sure. And some of that is just by paying less in taxes ultimately, or finding ways to get some of these amazing credits that you might not even know have existed. And the fact that you can go back 3 years, for those of you that have flipped a bunch of houses over the last 3 years, that you can go back and get $2,000 to $5,000 for each of those you flipped is pretty amazing. So make sure you're talking to Joe. Make sure you're keeping your ear to the ground. And another way to do that is by being on the inside at Investor Fuel. So you can always learn more at investorfuel.com. Appreciate you guys. Hope you got some good insights from today. Hopefully you saved a bunch of money. If you did, shoot me a message. I'd love to hear those success stories of people either making or saving more money because of something they heard through us. So Appreciate you guys a ton. We'll see you on the next show. Take care. Thanks for joining us for today's show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing on your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. You can also check out the show's notes for access to free resources, how to get access to world-class lead generation, and even how to work with me directly one-on-one. Don't forget to subscribe so you never miss another episode. See you on the next show.